Hi, everyone. This is Jason Barack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, although I've met him in person and spoken with him. He has a very interesting background. His articles are on Zero Hedge. He is the founder and managing partner of 720 Global. He's a chartered financial analyst, or CFA. He worked at Fannie Mae for 15 years, including during the 2008 crisis. I believe he left just after that from talking to him. And he also ran an investment firm for 8 years. Michael Lebowitz, thank you for joining me today.
Thank you for having me, Jason. I'm flattered to be on your show.
Now, Michael, did I get everything in your background correctly, or did I miss a couple things?
You pretty much got everything. I've done a lot in my career. I actually had a few years at Freddie Mac as well when I first came out of college. I've traded mortgages. I've traded agency bonds. I've traded derivatives. I've managed a rather large portfolio, non-mortgage portfolio at Fannie Mae. I went off onto my own, started what turned out to be a very successful investment management firm, managing all asset classes for individuals. Recently, I started 720 Global with a partner, and 720 Global is a consultant to other money managers, and it's our job to provide both macroeconomic advice as well as strategic investment advice, asset allocation, risk management protocols, etc., to help professional investment managers be the best they can be.
So let's talk about some of your analysis. You put out a number of pieces recently about the share buybacks. I guess you seem pretty passionate about that. It seems to me like, that's kind of a scam where the CEO, the chief financial officer, the upper management executives and board of directors, they're looking for creative financial engineering to goose the earnings with share buybacks to buy back their stock. Is that what you see, or do I see things wrong?
Oh, you see it exactly right. We have a piece. The first piece we wrote on buybacks was corporate buybacks, connecting dots to the F word. And by F, we meant the word fraud, scam, fraud. They're all great words to describe what's going on. And what you left out of that introduction was the fact that corporate executives are incented heavily to the tune of roughly on average about 80% by stock. So over the last 30 years, it's increased from 5, 10, 15% to 80%. So as a CEO, CFO, a corporate executive, you're paid by the stock price. As such, you're incented to get that stock price up. And there are plenty of ways to do it. In a perfect world, CEOs would be doing it by building, by investing, by training their staff, and growing a company over time. That's durable and sustainable. But CEOs these days have figured out that the market loves buybacks. And they love buybacks because, in my opinion, the market's not looking at both sides of the story. One side of the story is positive, and that's that when a company buys back stock, there's obviously less shareholders, and the earnings stay the same. So there's more earnings per share, and that's a fact, and that's a positive on its own. However, what's being neglected is the other side of the story, and that's the fact that cash and debt sometimes, but in a basic buyback, cash is going out the window, so the company's losing an asset. And what's even more important is the fact that these companies are neglecting investing in their company, be it R&D, capital expenditures, a whole number of ways that they can create growth in the future. And that is something that is completely being neglected by shareholders, as well as what's also being neglected is the effect on valuations. Price to earnings will drop as earnings per share increase. But when you take out the effect of the buybacks, these companies are way overvalued. And that's something that we've also written about and are very concerned about, that investors really aren't paying attention, and price to earnings are distorted lower than they actually are.
Yeah, the behavior is myopic and rent-seeking by the people, at the top running a lot of these companies. That a lot of them don't even seem to care 10, 15 years what happens to their company like maybe CEOs in the past used to, especially if they founded the company. These guys, they're trying to get rich quick. So they're trying to do whatever they can to beat, a couple quarters in a row, maybe for a year or two or three, and they're trying to get out with a golden parachute. Maybe their plan is to be a CEO for 3 years or 5 years and make, $50 million or more in stock options triggering, and they don't care what happens to the company after that if it's in better shape.
Right. It's a very short-sighted policy, and it will come back to haunt these companies, of which many of them. We did a study of the S&P, and 400 of the 500 are buying back shares.
Yeah, David Einhorn also put, I don't know if you saw it last year, he put out a whole piece in his letter to investors for Greenlight Capital, and he was also talking about how, a lot of these same companies, they'll call up the Wall Street analyst, which is normally just like a first or second year guy at an investment bank who maybe just got his MBA, and, they'll tell them, you have to lower our revenue projections, you have to lower our earnings projections, and, these calls come every single day for 2 or 3 weeks before the earnings announcement, so these guys can beat by a penny or two, so they can say, oh, look, we beat.
That's right.
When, the bar was lowered, 20, 30, 40% sometimes. People's memories are not as long as they used to be, or, well, you and mine are, but, the average person out there, they don't see that, well, look at how much the earnings revisions and the guidance was dropped and things like that. People don't think, and then the stock ends up higher.
Right. I think greed is playing. Bubbles are fed by greed, fed by a lot of things, but greed is one of them. And greed allows bubbles to go on much longer than they really should go on, and results in a magnificent blow-up of bubbles as well. But greed by the investors, not willing to do their homework, not willing to fully understand what a buyback really is awful, and it will have its price. Now, you talked about Einhorn. Warren Buffett in, I think it was 1999, wrote a great article. He was being confronted by shareholders, Berkshire Hathaway, to buy back shares. The company was depressed. Technology companies were doing great. Why don't you buy back shares? His response was, our shares aren't trading below intrinsic value. And then he basically listed out a bunch of reasons. And one of them, which is in our article, Buybacks, the F word, and in quotes, now repurchases are all the rage, but are all too often made for the unstated and, in our view, ignoble reason to pump or support the stock price. And he's right. He's right. The only reasons a company should do a buyback is if it's trading below its intrinsic value, so they can actually buy back the company at a discount, or it's just a non-growth company, what we learned in business school is a cash cow. And there really aren't that many of those around. Maybe some utility companies, a company like Philip Morris. But these companies in today's market that are leading the buyback craze are companies like Cisco, like Home Depot, companies that should be going for growth, future growth, investing in their companies, and are not.
Well, it seems to me you mentioned these guys trying to protect the share price and things like that. Not only do we have companies doing this with talking earnings analysts numbers down weeks before every single earnings call, and also the share buyback scheme, but we have governments doing it now and central banks. And you have a recent piece out about China. And China has been one of those too. They had a big stock market run up in the last couple of years, and then in the last couple months they've had a big bust. And they tried to stop it, with outlawing short sales and things like that. And then I could go on about so many different other major countries, whether it's Japan and their central bank trying to buy ETFs and prop up their bond market. The U.S. is trying all kinds of different games to prop up the stock market and things like that. I mean, if you listen to other sources, you'll hear that there's, the Exchange Stabilization Fund or the Plunge Protection Team, the Working Group on Financial Markets. Apparently there's two of these groups, and they're trying to buy, it seems like almost at the end of each market close, there's these random, very large $10, $15 million purchases of S&P 500 futures on the long side that come out of nowhere when the support levels are about to break on the charts. Is that what you see too from central banks and governments?
It definitely seems that over the last, or actually past the financial crisis, that central banks around the world are much more in tune with what's going on in markets, and they seem to strongly believe that a strong market, a strong stock market at least, is beneficial to a strong economy and to ultimately achieving their goals. Now, some countries do it very out in the open, like what China just announced, where they have put a tremendous amount of money into buying shares. They have limited short. They have actually threatened short sellers with jail. Other countries, like you mentioned, Japan as well, is buying ETFs. They're not buying the entire market, but they're buying certain sectors. And then there's more. You don't really know what's going on with the United States. There's a lot of weird trading activity. I'm not saying the Fed is involved or not involved, but they certainly like talking up the market. They want to promote a healthy market. But what they're all doing is what happened in China. China happened very quickly, so it's nice and easy to dissect. The stock market went crazy up until a couple months ago. It was up, it at least doubled. It was up more than that in a year and a half. And China was feeding it. China was allowing more margin, they were lending more money into the market. They were feeding the fire. And eventually markets get to a point where there are no more buyers. Valuations get completely out of control and they collapse. They fall on themselves. And I think we've seen a similar thing here in Japan and in many other countries where these markets have been propelled by, whether it's manipulation, but at a minimum, it's Fed talk, Fed support of the markets. The Fed will bail out everything. There's nothing to worry about. The economy will always grow. Companies will always make money. And it's fed in large part by the Federal Reserve. And we're getting to that point where valuations make 0 sense and the market is showing signs of some weakness, and it has been for 6 months. It's been stagnating since QE ended. But we're at some pretty precarious points that investors should be very mindful of at this point.
Yeah, and also the central banks are giving the Wall Street investment banks and the hedge funds basically free money. They can borrow near zero, whether it's out of Japan with a yen carry trade or carry trades in other different currencies. And these guys can go in and borrow and move the asset prices and things like that. So, I mean, all these assets, Michael, seem to me like they're all being bought with enormous amounts of leverage for the most part.
Yeah, that's correct. And, I'm sure you've seen the same margin graphs I've seen, but the amount of leverage being used is incredible. There is almost no cash sitting on the sidelines at mutual funds. Investors are pushing all their money in. We are hitting that point, whether it's today or whether it's 6 months from now, we're hitting that point where it's not sustainable anymore.
Well, this is what has to happen in, a debt-based fiat money system. The money supply and the credit supply has to keep rising. So they have to keep finding either new markets or new bubbles to create. So that's why, there's subprime auto and, subprime student loans, basically, which are essentially subprime too. A lot of them are in default already. So that's why they're throwing the credit, easy credit, subprime auto loans too. Yeah, too, at those things. So, I mean, like we had a Chris Martinson, I don't know if you've seen it in his new Crash Course. He has this little video where he shows a tiny little drop in the credit amount. I think was 2008, 2009. It was a tiny little drop compared to the last 15 or 20 years. And that caused, almost everything to collapse. And now everything's, back on track and going vertical again.
Right. And the numbers are bigger this time. When we wrote a paper recently on China and the yuan devaluation. And in it, we talked about the carry trade. So the carry trade is basically where an investor will borrow money in the United States and then invest it abroad. And a lot of that, not a lot, but a quarter, a third of that money has gone to China. So the investor, in borrowing in U.S. dollars, converting to Chinese yuan, and then investing in some sort of company or enterprise in China, has an embedded a short dollar position, which is fine. The dollar was trading weak for a long time, so they were making money on that position. China was going gangbusters, making money on that position. Their interest rate was really low. It was a wonderful trade. It worked well. But now we're seeing a strong dollar, and that is a big problem for that carry trade. There's $9 trillion of it. In the Asian crisis in 1997, there are estimates that number was 250 to 500 billion. So we are multiples and multiples above where we were then. So an unwind of the carry trade, even partial, small unwind of the carry trade, can have massive effects. And I think we are seeing capital flowing out of China, and we are seeing some devaluations around the world, especially in smaller countries, simply as a reaction to that relatively small China devaluation that we saw a week or two ago.
And in one of your recent China pieces that you mentioned also, I think you said you expect China to do more devaluations going forward, which does not bode well for the other Asian countries like Japan and South Korea and Thailand and stuff. I mean, they're not going to just sit back and let China gain some type of advantage in the exchange rate. So we could see, a new round of currency wars restart, where the Asian countries are all trying to devalue to get exchange rates favorable for trade, because China wasn't winning that, and Japan had devalued the yen so much against the dollar for a while and things like that.
That's right. China appreciated their currency since 2006, so it was almost going on 10 years where their currency appreciated. In fact, since I believe it was 2011, called 4 years or so, the yuan's appreciated 35 to 40% against its trade partners. That has made them very less competitive than they were. And even in the last year, we've seen, while the yuan was pegged to the U.S. dollar, the euro has been down 15-20%, the yen has been down 20-25%, the British pound, the Canadian dollar, the Australian dollar. China is becoming very uncompetitive in exports, which is something that heavily supports their economy.
Yeah, I completely agree. And, these Keynesian central planners, whether it's China or running so many other central banks, pretty much every central bank in the world is a Keynesian central planner. Their theory, Keynesian theory, is based off mercantilism, which is, devalue the currency to boost exports. But the problem is, they're all trying to devalue at almost the same time, although, the U.S. and Japan and Europe, I think they've basically been taking turns. They've been kind of working together and coordinating things like, oh, okay, Japan, you can devalue, and oh, okay, U.S., you can devalue. The U.S. devalued first, and then Japan has devalued recently, and Europe has devalued recently, and the U.K. has devalued. But I think it's the emerging markets that are in the most trouble because they have dollar-denominated debt. So they may be the new subprime because, a lot of those currencies you mentioned, they're commodity currencies. So they borrowed in dollars because it was cheaper at the time. And they took that money and they invested it in, base metals or oil projects and things like that. And, now that the commodity prices are down so much, the debt is fixed and the asset values have dropped and the cash flow is either not there or has dropped a lot. So, that does not bode well for these emerging market countries.
Right. You are dead on with that. And I think the other interesting part is what you started with was that at first they were taking turns. Europe, Japan, the U.S. It was almost like a merry-go-round. Whose turn is up next? And that's what it felt like. Now it feels like chaos. Like they're not taking their turns. They're just jumping in, and that has very different ramifications for not just the emerging markets, but for the financial markets in the developed countries as well.
Yeah, we've seen over the last 2 or 3 years a lot of flight capital from the developing markets come into real estate in London, real estate in Canada, real estate in the U.S. What's viewed as geopolitically safer. A lot of money has come out of China into safer real estate markets in other countries. We've also seen a lot of that money that was in emerging market stock markets and things like that, and also in commodities. We've seen a lot of it go into the regular stock market, into mostly safer dividend stocks. So we've seen a lot of flight capital. My question for you, though, is about the Fed. The dollar is getting stronger here. I think Janet Yellen made it pretty clear because she was leaking it to her cronies, at the Wall Street Journal and things like that, who are basically mouthpieces for the Fed, that they did want to try an interest rate increase here in September. It doesn't look like that the probability of that's going to increase. Do you think they're going to try to do a token rate increase soon, or do you think now that the China and the currency war seem to have restarted with China and maybe other countries, do you think they're going to get scared that, the dollar's already strong and we can make it too strong and really crash things?
And that's a question I've been debating with a few of my colleagues, my friends that I talk markets with. The sentiment seems to have drastically changed since the Fed meeting, and now with what's going on in the market, that the Fed is going to wait and not do anything in September. A week ago, it was probably 60-40 that the Fed was going to raise rates. I still think the Fed may raise rates. Now, they may only raise it in a kind of a half step. So right now, the official Fed funds target, I believe, is 0 to 25 basis points. They may make it a firm 25 basis points. So it's not a rate hike, but it's affirming, since the effective rate tends to be 10, 15 basis points. It would be roughly half a 25 basis point hike. And I think what's involved is not the economy is certainly not saying we need a rate hike. The economy is slow, growth is slow, and on the inflation front, deflation is the much bigger concern, not inflation, at least statistically, according to the BLS. So the one thing that pushes the Fed is employment. Now, the unemployment rate is doing well, and the monthly employment payroll numbers are doing well, but there's a lot of other indicators that tell you the employment sector is very weak, the participation rate, and what I like to look at a lot are wages. If the employment sector were so strong, wages would be increasing. If people are in such demand, they would have the ability to demand higher wages, and that's not happening at all. So I think if you just looked at economics, you'd say the Fed's crazy to even think about raising rates here. But on the other hand, the Fed has now gone almost a decade. I think it's 9 years since the last time they raised rates, which is pretty incredible when you think about it. And they wanna have that moment where they can wave the victory flag and say, we did it. We raised rates. And I think they've built that into their heads. And their egos now, at least Janet's ego, may be driving this to the point where they actually raise rates.
They may try a few token ones. I don't know if they'll try one in September, but they may try some in 2016 or 2017, maybe to get up to 0.5% interest rate or a couple token ones of quarter points, like you said. But I think there's almost zero chance that they can normalize the interest rates. There's a math problem. The U.S. isn't Japan, for debt to GDP or interest payments on the principal yet. Mm-hmm. We're not there yet. Japan is by far further down the road. But, it would take up so much of the tax revenues by raising rates. They'd have to pay the debt. I don't think it's feasible. I think it would pretty much crash everything. And there's also, I don't know if you pay a lot of attention to Rob Kirby's work over at Kirby Analytics. He says there's over $100 trillion in interest rate swaps that are out there that don't have any collateral and things like that have been sold that trigger if the interest rate spikes. So I'm not really big on thinking that we're going to see 3, 4, or 5% interest rates anytime soon, maybe if ever again, until we have a complete reset of the system.
I would agree with that, but I think I differ a little. I'm not sure the Fed can even get up to 50 or 75 basis points. I think once they go once, maybe twice, and they start developing a trend or expectations, the markets will not be happy. And the Fed has proven hostage to those markets. And I think a 15, 20, 25% drop in the stock market, and the Fed will not only be cutting rates all the way back to zero or possibly even below zero, like some other countries have done, but they will be embark on the next round of QE.
Yeah, Grant Williams calls that the taper tantrum. Yeah, I think we're going to see a lot more of those when they try to take away the punch bowl, so the hedge funds and the investment banks can't do any more carry trades with free money and things like that.
Valuations make zero sense. We actually just put out an article today dissecting the earnings expectations within valuations. And basically, if you're buying the S&P today, you're expecting earnings growth of roughly 15%. That's crazy. You have an economy that's growing 2-3%, and earnings over the last few years have been growing 3%. To expect that kind of growth in this kind of sluggish domestic economy and struggling global economy is ridiculous.
Yeah, you're using the government statistics. When I count the real inflation rate, I mean, I don't know what your definition of inflation is, but if we have listeners to our podcast in New York, and their property taxes, we've heard from them over the last 10 or 15 years, have gone up massively. So I don't know if you count that as inflation or not, but people are getting, inflation in food, inflation in rent, stuff like that. And the Bureau of Labor Statistics, the regular statistics, they don't count that. They just come out with new ways to reduce that in some type of assumption and models and formulas and things.
Hedonics. Yeah, they've been doing that for a while. And I don't consider the CPI or PPI or any of these deflator the true inflation number, but it is the number that the markets rely on. But it is interesting that our daily costs, the stuff that comes out of our pockets all the time, healthcare, rents, a whole number of things is going through the roof, but it's not captured properly. And accordingly, we have no inflation. Asset prices are another thing. It's a type of inflation that's just not being counted.
Oh, yeah, I agree. I interview mainstream Wall Street financial analysts who aren't libertarian or Austrian school economics, and they read, Wall Street Journal, most of the mainstream stuff, and CNBC and Bloomberg most of the time. And, I try to get them on record to admit that there's enormous asset price inflation, and, they won't do it, I guess, because so much of their bonuses and stuff are predicated on it.
Right.
So they won't talk about that because I guess they want to see that, I picked out these winning investments, I'm so skilled and things like that, not that, a rising tide lifted all boats.
Right. The other thing, when you talk about CPI and wages have done very poorly, even against CPI. But CPI is not my family's budget is not CPI. I can tell you my healthcare costs have gone through the roof. Insurance has gone up a lot. My real estate tax has also gone up a lot, like you mentioned earlier. All kinds of other expenses. So even though we think wages may be flat, up slightly, down slightly versus CPI, wages are down as far as what they can buy, what they can earn. And that's been going on for a long time, and the consumer has made up for it by borrowing money. They borrowed money to maintain this semblance of wealthiness to some degree, whether it's cars, houses, all kinds of things. But that limit has been hit. That limit got hit in 2008. The consumer is not really in a position to take down much more debt. So trying to entice these consumers with low interest rates, with great auto financing deals has its limits, and I believe we are very close to those limits.
Yeah, and teasers on credit cards. Yeah, I mean, the old middle-class lifestyle decades ago used to be able to have it where you wouldn't have to work every single day. You had savings, that you could support a family pretty easily on one family income and things like that. Those days are long gone for the most part, unless you're a hedge fund manager on Wall Street or you're the CEO of a pretty large company.
Yeah, the top, it's not even 1%, the top 1/10 of 1% is driving. Household net worth in this country is gone up significantly. But when you really break it out, it's really just that very, very upper echelon that is driving that number. And the rest of us, and that includes even, when I say the rest of us, it's not just poor and middle class. There's some decently wealthy people that are still getting left behind. So if you really think about, I had this discussion with a friend of mine, what it takes to retire, the fact that you're going to earn 2 to 3% if you want to take some risks in the bond market means that you can't live off the interest of your wealth. You need to extract the principal from your wealth. And that means that there are very few people in this country that are in any shape to retire in a way that in the life that they're accustomed to today.
Oh yeah, I completely agree. Yeah, the odds of someone having a comfortable retirement now. I unfortunately have family members who didn't invest properly and have run out of money for their retirement. So they don't listen to this podcast, but they listen to their regular stockbroker and financial advisor. They didn't make good investments. They spent too much money. It happens. I'm sure it's going to happen a lot more. That's just how life is now.
And just one quick thing, add to that the fact that the stock markets are basically a couple percent off their all-time highs. What happens if the stock markets, like what we saw in 2008, 2009, they've dropped 30, 40, 50, 60%? Well, then these people have real problems.
Yeah, I think we're starting to see evidence that I don't know if the government statistics account for this, but we see a lot of people, whether it's kids graduating after college or middle-aged adults who lost their job or older folks who are retired or trying to retire, they ran out of money and now they have to go live with their kids or like I said, the college graduates have to go move in with their parents in the basement. We're seeing a lot of that. I don't know if the statistics capture that, but I've heard it's upwards of 35-40% across the United States.
Right.
And that would be very similar to what happened during the Great Depression in 1929, which was a deflationary period. You expect deflation, but when I look at financial history, and I know you like that too, I only see in the United States the Keynesian central planners allowing deflation really from 1929 to 1933 before they devalued the dollar against gold. They did all these wage and price controls and all these other things to basically stop deflation for the most part and get kind of a weird type of stagflation before World War II started. There were massive interventions by both Herbert Hoover, who wasn't a free market guy, and also FDR. Do you think the central planners in power are going to actually allow a real deflation to occur for a long period of time?
Yes and no. I think I agree. I think we will have deflation. I think we will have very, very high inflation. I'm not going to say hyperinflation, but I think we will have extremely high inflation at some point as well. But in the meantime, especially with the stronger dollar, we are importing deflation from around the world. And if China continues to devalue, if they devalue 15, 20%, we're importing a lot of deflation. That on top of oil prices, which have dropped significantly, and assuming the economy slows, which I believe it will, the deflationary pressures will be immense, and I'm not sure that a little bit of QE will help. I think a lot of QE will create a little inflation. Ultimately, at the end of the day, I think all this money printing, and we've quadrupled the money supply, and by the time they're done, it'll probably be more than that, will create inflation of a serious magnitude. But in the meantime, we're stuck in this deflationary, very low growth atmosphere. And low growth is being generous too.
Yeah,
I think potentially we're looking at negative.
Yeah, with the real inflation rate in the real world,
I would starting to see around the world.
Yeah, with the real inflation rate in the United States, I would call it stagflation that we have right now. It's not super high levels yet, but most of the inflation has either been it's gone into the asset prices or it's been exported to other countries, because we still hear from some of our listeners in other countries that their bills are going up a lot faster than in the U.S.
That's true, but I certainly wouldn't call it hyperinflation.
Oh yeah, hyperinflation is more of a emotional, psychological thing, where the people like in Greece or Argentina or Zimbabwe, or Venezuela now, they have to get rid of the money, as fast as they can. There's crazy wage and price controls. The goods disappear from the shelves. There's no toilet paper or beer or things like that. We're seeing it play out right now in Venezuela.
And I do think that is where we get into our inflationary stage, where people just finally do not trust the money and they'd rather have other things. And, I think you brought this up earlier, what we're seeing in New York, in L.A., even here in D.C., we see it where a lot of foreign money is coming in to buy property. And they don't really have an opinion on the U.S. property market, a lot of them. They just want their money in a hard asset in U.S. dollars. And that's their way of not being in their own currency. And I think I think we'll see that here, not to a hyperinflationary degree, but to a large degree, where they've realized that the dollar is not what they think it is. It's something that can be printed at random by a central bank that seems more concerned with the very wealthy.
Yeah, and it's not just the U.S. who's printing. I mean, it's so many other countries who are printing. I mean, China is printing, Japan is printing. They're all trying to flood the market with massive amounts of dollars. They all want inflation. They view that as better. But, they've created enormous amounts of debt that their economies can't handle across all levels of the economy, whether it's the Chinese municipalities or, the Japanese banks, which they haven't fixed even in a couple decades. And, in the U.S., it's just massive. Same thing with European banks. So it's just a global debt problem, and I guess the only way I see that they can keep the game going without a total collapse is for them to print more currency and maybe also go after people's savings and retirement accounts. I really don't see any other way that they can keep the game going, with the math.
Yeah, I mean, I think they'll do what they've been doing. It's worked. It's worked in their minds. They really just make the problem bigger, but it avoids the hard part, which is when you have to come to grips with reality and how the real world works ultimately. And that's what's going to be very tough. But ultimately, it's something that I think we should think about as, well, it'll be certainly hard times. It'll be good because things can change. We don't have to run our economy purely based on materialistic spending on borrowed money. We can spend what we earn. We can live within our means. We don't need to take advantage of the U.S. dollar being a reserve currency. We can be productive again. This country's productivity rate is almost flat right now, and the productivity rate of the world is flat, but many major countries are negative. And that's because we're not investing in the future. We're investing in goods and our desires.
Well, rather than bailing out governments or banks or things like that, I would have rather have seen the money spent, on new airports and bullet trains in the United States and improving infrastructure and the corporations with their money, instead of share buybacks, I would have rather seen that money spent on research and development for new products and services and new technologies and things like that. But we really haven't seen any of those things, any of that capital allocated to those things. Like I said, it's been a very tiny portion.
Right. And if you look at what FDR did in the 30s, like it or not, and there's certainly some pros and cons, but what he did was, instead of giving money out, he made people work for the money, and they ended up building dams and the TVA system and all kinds of things that are still providing us economic benefits today. So like you said, I'd rather see that money put to use in something that provides future benefit, as opposed to basically giving money so they can go and buy more stuff.
Yeah, or maybe we'll see tax cuts to small business then, and there can be taxes on something else instead of the tax system we have now, which is totally screwed up and way too complicated. My final question for you, since you didn't manage money, what do you think most people should be doing right now? Do you think they should have a large cash position? Should they also have precious metals? Should they have some puts on the exchanges, on certain stock exchanges? What do you think in general? What asset classes should people avoid, and which ones should they look at right now?
Stocks in general, and this doesn't mean every stock, but the major indexes at least, and many of the stocks within them are very overvalued. I know we're brought up in a system where you have to own stocks. Everyone owns stocks. If you're 50 years old, you need to own 75% stocks and 25% bonds. We have all these formulas that Wall Street made for us that are not correct. So it's okay to only own 15% stocks. I think the less stocks you own, except with the exception of deep value stocks, is good. There's no reason to load up on stocks at these valuations. It's just crazy. Bonds, I consider myself the greater fool. I like bonds here. I know that there will be a greater fool that will buy them from me at a higher price or lower yield.
Yeah, the government will.
Well, I think investors are going to be forced to it too. When people have to sell out of their stocks, when that money coming from abroad gets repatriated back to the U.S., it's going to be chasing what's perceived to be the safety of U.S. Treasuries. So I like bonds, but I would never tell you to buy a 10-year bond and hold it to maturity, because I think that's a bad investment. But I love buying 10, 30-year bonds now on a trading basis. Precious metals, especially gold, I think deserves a place in every portfolio. Now, whether that's 5%, 15%, that depends. But I think of it as insurance, an insurance policy on money. And when money is treated properly, when it's not printed, when it's treated with respect, the need for the insurance is rather minimal. When it's being printed and games and manipulation are being played the way they are, I think it's important to have a portion of your portfolio in precious metals, in gold and silver. The exact amount depends on the holder's threshold for volatility. As we've seen, gold can go up and down. Silver even more so. They are very volatile, but they are insurance policies. And I think in the long run, when we get through this whole cycle, those that own gold, even if they bought it at 1,800 and it's currently well below that, will be very happy. Some of
our listeners who did buy at those levels of gold and silver, they're not very happy right now. I've read the comment section, and one of them I had to block. He was just getting ridiculous there. He, as an adult, very smart one, and can't take any responsibility for his own problems.
Yeah, you know what? But like an insurance, I tell you the truth, I'm not even sure where my personal life insurance policy is. I know I have it, and I think I know where it is, but I don't look at it every day. I don't value it every day. I know that I'm writing a check once a year for that policy. That's money that's hopefully being thrown down the toilet. And when I need it, if I need it, it's going to be there. And the difference now being that my health has relatively stayed stable, luckily. The dollar's health is not stable. Just because it's rising just means it's rising against other currencies. The value of the dollar has been hurt significantly by the Federal Reserve, which has printed enormous sums of money that is incredible if you look at it on a historical basis. So I want insurance. I want more insurance. I want more insurance today than I did 5 years ago, purely because of not just what the Fed has done, but what I perceive the Fed will be doing.
Yeah, and a stronger dollar is actually going to hurt the earnings of a lot of U.S. corporations that do a lot of business overseas when they announce the earnings numbers. So it's not going to benefit them.
Right, and the gold can go up with a strong dollar. Metals and commodities tend to do poorly when the dollar does well, and vice versa. But that hasn't always been the case. There are certainly periods where the dollar's done well and gold's done well, and we have to remember that when we say the dollar's doing well, that means it's doing better than the euro, than the yen, than the pound.
That's not a compliment.
Yeah, it's the cleanest pig in the sty.
It's a backhanded compliment, yeah.
So just keep that in mind.
Well, Michael, I just want to thank you for your time today. And, how do our listeners sign up for your email list if they want to get your newsletter as soon as your new articles as soon as they come out?
They can go to www.720global.com and click on Contact Us, and there's a little form where they can enter their appropriate information and join our mailing list. And also feel free to, there's a message field, feel free to ask any questions. We'd be happy to address them. If you go to our website as well, under articles and commentary, you can see the prior articles that we have written. And again, like I just said, feel free to ask questions.
Okay, great. Well, thank you for your time. And, we should have you back on every couple months to get your opinion on the markets. I enjoyed this discussion.
That would be great, Jason. And thank you very much for sharing me with your viewers. I appreciate it.